makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacqua in London this morning. Here's what's coming up on today's programme. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures. The Aussie dollar rebounds from earlier declines. Hitting back, China ups the ante in a trade war with the US and Europe, imposing restrictions on two metals critical for chip manufacturing. Plus, crude rises after Saudi Arabia and Russia announced an extension to oil supply cuts. Welcome to the programme, everybody. Welcome to The Pulse. I'm Anna Edwards in London, then in for Francine Lacqua this morning. Let's get straight to the markets and a quick check of where we are on some key assets. Of course, we are without the United States today. We see European equity markets going modestly higher, up by 0.2%. We see this morning S&P futures in there, even though we obviously know there's no trading of cash equities in the US later. But we do have the futures picture. It's not telling us a great deal, is it? Flat on US futures right now. In terms of the oil price, we're up 0.8%. Yesterday, we saw, as a result of that news out of Russia, that they're towing the line with Saudi Arabia, with their OPEC Plus colleagues. They're singing the same tune, if you like, and talking about restraining output. That did pop the oil price up to $76 on Brent, but it pretty quickly came back down to something with a 75 handle, and we continue to trade in around that range. 149.64 on dollar, Aussie dollar. And what's been interesting here is we did see the Australian dollar a drop in the immediate aftermath of the RBA's decision. The economists had been split 50-50 as to whether we'd see a hike or not. We didn't get that hike, and so those who'd been anticipating it perhaps a little bit disappointed. We saw a drop in the Aussie dollar, but that was short-lived. More hawkish rhetoric coming through from the RBA, so a sort of hawkish hold perhaps, and the Aussie dollar recovered a little bit. Let's have a quick look at the map for you across Europe then, and what we see on equity markets. So the Stoxx 600 up by 0.1% or so. We're flat on the FTSE 100 and the CAC 40 and the DAX. The IBEX in Spain moves a little lower. There's a lot of grey on that screen today, isn't there? Real estate is one of the best performing sectors. That is the only one, in fact, up by more than 1% on these markets. Basic resources under pressure today, down by 0.6%. Joining us to take a deeper dive into markets, Bloomberg Markets Today editor Christina Aquino is still with us. Columbia Threadneedle head of global equities Melda Mergen is with us as well. Welcome to both of you. Thank you very much for joining us. Melda, let me come to you first then. And thinking about, or jumping off the RBA's decision here to hold, does it tell us anything useful from a global perspective about the value in waiting for lags to sort of, for the real economy to catch up? Does it have any read across? Do you think we'll see more pauses from other central banks?
I think we will. I think all the central banks are really focused on bringing down inflation, but we also know that when they start tightening there is a lag, and I think it is a little bit of wait and see. We are starting to see around the globe every macroeconomic signals we are looking at, it's starting to slow down. So I think they are trying to assess how far they went.
Yes, and what do stocks do in the face of that? Because at one point, stock markets were very much being driven by expectations of what the Fed does. When we get to a pause, we know now, we had a pause already, whether we go back to hiking or not, this was the dominant narrative. But then you overlay that sort of tech enthusiasm for AI, and that was a different sort of structural factor coming through in recent months. So how does the equity market cope with higher rates?
Equity market does not prefer uncertainty, so anything that is not becoming a trend is a problem in the way of wait and see in the equity markets too. That being said, a lot of work being done in the equity markets as an investor is discounting the future cash flows, future earnings. So there are some secular trends, as you suggested. AI is one of them. Still will be focusing on it. When it comes to macro, though, I think equity market is pricing in the worst is over, and then waiting for the inflection point. So I think equity market is going to be also wait and see for a while.
Equity markets then, Christine, pricing in the worst is over in terms of rate hikes. I guess that's what you conclude when you look at the extent of gains that we saw in the first half of this year.
Absolutely, Anna. But I think, as Melda was saying, it's dangerous to kind of think that the rally is going to keep continuing from here, right? We have seen warnings from several investors saying, don't get too greedy in chasing the equity rally, because it does look like it's not over when it comes to rate hikes here. The Federal Reserve may have paused in June, but they're very much saying that, look, we're going to be data dependent. We're going to take a look at how the second half unfolds, but we're definitely far from over as far as trying to contain that inflation rate, which is still very much above their target. That is the case for a lot of central banks at the moment.
Melda, given that you head up global equities, I wanted to get your sense of the earnings season that is ahead of us. We've seen quite resilient profit margins in the face of much higher global inflation. Where do we stand on that story, on that narrative for you?
It will be another earnings season. I think we're going to hear more cautious message from the companies. They will start seeing maybe the effect on the consumer, as we are seeing in some of the leading indicators, that the consumer is definitely cautious and being careful with the spending.
You see signs of that then, consumer
Yes.
hesitancy?
Exactly, and it's around the globe. Everybody's cautious except UK. I think UK still has the tailwind from some of those savings being, because of the energy crisis carried over this year. But we see that, and companies are really trying to both manage the cost of capital side because of the rates being higher than usual, but at the demand side, which everybody's expecting, it's by design that the demand is going to slow down.
Okay, so yes, demand slows down, and that is by design. The cost of capital is an interesting one because perhaps with long lags in this cycle, we've seen companies manage to push off the effects of higher interest rates because they use the opportunity, I was told in the last couple of hours of programming, to raise more money whilst rates were really low. Do you see that we're entering then a new environment where we don't go back to the low interest rates of the past and companies have to get used to paying these kind of higher rates?
Yes, the equilibrium the next time with the interest rates or the inflation, I think, is going to be higher than what we experienced before the pandemic. So companies talk about it very openly. It's just that the way that they are coping with it, especially the winners in the market, is finding ways to keep that cost of capital, minimum debt, and also digitalization and other ways of making sure that their operations are more efficient.
So does interest rate cover become one of the factors you look at, one of the tools that you analyse balance sheets with at this kind of point?
Exactly, and valuation is going to be more important than previously. With low interest rates, valuation takes a second kind of, importance in the way that you think about the cash flows in the future. But going forward, the conviction is, the rates will be higher, so you need to pay more attention to valuation.
Okay, so Christine, so we pay more attention to valuation because interest rates are higher, and perhaps we focus in on interest rate cover, so businesses that are able to pay their interest rates essentially versus those that are not. I was talking about dividend payments in the same context with Ewan Munro earlier from Newton, and he was saying you've got to look really careful at these individual businesses because just because some ratio might suggest they could pay their dividends, that we're entering difficult times where not all dividends are going to be certain. But income, an interesting theme right now.
Absolutely, Anna. And I think that's really something that companies are starting to look at, as Melda is saying, and really trying to be a bit more defensive on, And I think that's also evident from the overall kind of earnings season outlook that we've just gotten, both from the UK and the US. Like a lot of companies still doing well, healthy profits overall, regardless of sector. But I think there's still that kind of undercurrent of caution that we've seen from their future outlooks. And so, you can tell the companies trying to kind of keep the powder dry for tougher times, trying to cut costs where they can, and again, trying to kind of address those interest rate driven costs now versus the future where rates could potentially be even higher from here.
Okay, Christine, thank you very much. Christine Aquino joining us from the Bloomberg Markets Today blog team. Melda, thank you as well. Melda Mergen joining us there from Columbia Threadneedle. Let's head on to matters UK and perhaps political. UK Prime Minister Rishi Sunak is set to appear before Parliament's powerful liaison committee today, where he'll be quizzed by MPs, almost certain to come up, questions over the future of the scandal-hit Thames Water. I'm pleased to say joining us now, Sir Vince Cable, former UK Business Secretary and the former leader of the Liberal Democrats. Sir Vince is now a professor in the School of Public Policy at the London School of Economics. Vince, thank you very much for joining us. We appreciate your time. We've heard from a number of shareholders then at Thames Water that there is some enthusiasm for a capital raise. Does it seem then that we've avoided renationalisation at Thames Water? It's hard to see this as the end of the conversation.
Well, if the investors are willing to put in more cash, then that at least temporarily solves the problem. Of course, Thames Water isn't the only water company in trouble, but a capital raise from the government's point of view is by far the best option, though there will be painful conditions. I mean, I would imagine that the investors are expecting to see prices rise to ensure that there's an adequate return in future. But if the capital raise falls through, then the government is forced back into public ownership because you can't just allow a water company to collapse. It's a fundamental service. And if that happens, of course, all the liabilities of the company go onto the public sector balance sheet, which in the UK are worrying. We're already 100% debt to GDP. So I think if the government can avoid nationalisation, it will, and will presumably have to make some concessions to the investors to stop that happening.
Yeah. How would you expect this to develop politically, Vince? There does seem to be some pressure from parts of the Labour Party, obviously not your political affiliation, but I'm interested in your assessment. Some Labour MPs calling on the opposition leader to reintroduce policies around renationalisation of water. Would you expect to see that?
Well, there may be calls for it, but I mean, the problem of actually how you handle public debt, which of course was the whole reason behind privatization in the first place, was to try to get these big utilities off the public sector balance sheet. It remains a big problem, but politically there's a lot of anger around. I mean, after all, these water companies have failed to deliver some essential public goods. We've got this problem of overflow of sewage because of underinvestment in the sewage system. There's a lot of leakage. I mean, the real anger is essentially about things in the past. I mean, it's the way Macquarie took advantage of lax regulation to pay out very large dividends that were completely unjustified in terms of a fairly safe utility. I mean, that anger is there, but of course it's happened in the past. We can't retrieve the past. But the politics of this are quite toxic for the government.
Right. And so, do you think that the sector has, I mean, some people have argued that the sector has a private equity problem, not a private ownership problem. From what you've been saying and the strains that renationalisation would put on the public purse, you might agree with that view.
Well, I think where this is heading is to a tougher regulatory regime. I think the problem is not a problem of privatisation, but more a problem of very weak regulatory operations. The regulators in some cases have been captured by the industry. You know, regulators went off to work for the private companies at much higher salaries. The regulation has been applied very flexibly. A lot of things have not been enforced. And I think the pressure will now be on to have a tougher regulatory regime. Now, how you reconcile that with trying to get in more private capital to make up the deficits of investment is a tricky one. And the obvious logic is to move to higher prices, which in turn is very difficult in the middle of a cost of living crisis.
What do you make of the sort of complex structures that seem to exist in some parts of the utility space in the UK, Vince? I'm talking here about layers and layers between operating and holding companies, parts of the company, or many parts of companies issuing debt. This was the situation at Thames Water. Some parts of the company relying on dividends from other parts, domiciled parts of the business in Luxembourg, Cayman Islands. Is there a place for these kind of complex structures in what were previously public utilities?
Yes, well, this is, of course, not just an issue for the water industry, but this is a phenomenon we've seen, and that was essentially how Macquarie, who were somewhat the villains of this story, took advantage of Thames Water, were able to extract very, very large dividends, which were simply not justified. I mean, this is a low-risk utility, after all. And they took advantage of it. The regulators seemed to be unable to get a grip on it. And there will be enormous pressure, I think, from now, if the industry remains under private ownership, to severely limit the freedom of the shareholders to operate in these complex, tax-avoiding, dividend-maximising ways.
It seems Ofwat has recently increased its powers to link dividend payments to performance for customers and performance for the environment, Vince. Is that moving in the right direction?
Yes, it is. And there is, of course, a complex issue of regulation here because there are different agencies managing regulation. You know, the Environment Agency has been dealing with one set of issues, Ofwat with another. And of course, there are other aspects of regulation feeding into all of this. But a consolidation of regulatory functions and a strengthening of them is clearly what's now required. But, you know, there is always an element of this that you're closing the stable door after the horse has bolted.
So Vince Cable, thank you very much for joining us, former UK Business Secretary. Thanks for spending time with us here on Bloomberg Television. We'll have more on Thames Water coming up later in the programme. Coming up, Beijing is to impose restrictions on exporting chip-making metals. More on the US-China tech standoff next. This is Bloomberg. Welcome back to the Pulse. Now, the tit-for-tat technology clash between China and the West is escalating. Beijing says it's to impose restrictions on exporting two metals used in the semiconductor, telecoms and EV industries as the US and China battle for technological dominance. Bloomberg's Rebecca Chung-Wilkins joins us with more. Rebecca, tell us more then about these curbs, not an entire ban, but curbs on the export of two metals in particular.
Absolutely, Anna, and that's important to remember. Just a restriction. It's a restriction on two key metals that are used in a variety of industries, but critically here, semiconductors, defence and communications. Now, these two metals, it's not really an issue of how rare they are, but how costly it is to produce them. And they really produce as a byproduct of refining other types of commodities. And China supplies at the moment about upwards of 80% of the world's use of these two metals. So the really big picture here is basically that China is showing a new willingness to try and tackle and push back against containment.
And how significant is this? As you say, not a full ban, it is just a sort of reining in of some of the export. And what are the longer-term implications?
Well, there is this risk that actually this move does eventually backfire on China. And we have seen a similar attempt, for example, by China to limit its exports of rare earths in the past. And eventually what happened was that actually countries just accelerated their efforts to sort of diversify their supply chains and remove that out and essentially just diminish China's portion of the market share. So the risk is that if China does enforce a sort of sweeping, more rigorous curb, as you say, we don't really know what this is actually going to look like, how much is going to be limited to other third nations. But if China does move to this, it could really just emphasize and sort of accelerate that move by the US and allies to find alternatives to China when it comes to these two specific metals.
Yes, and our story does point out that it is possible to find alternatives. Rebecca, thank you very much for joining us. Bloomberg's Rebecca Chung-Wilkins with the latest on that geopolitical tension and the mining sector falling into that. Coming up on the programme, we'll talk about extraction of another variety. We'll talk oil. Saudi Arabia is planning to extend its oil production cut by a month, keeping a lid on supply as fears remain over the global economy. More on that next. This is Bloomberg. Welcome back. Let's focus in on the oil sector. Oil futures are making gains. That's after Saudi Arabia said it will prolong its unilateral output cut of 1 million barrels a day through the month of August, warning it may extend even further to prop up prices. OPEC Plus ally Russia announced fresh curbs on its exports. Let's bring into the conversation Bloomberg's oil strategist Julian Lee, who's with us in studio this morning. Julian, good morning. So how significant is this move from Saudi Arabia and Russia?
Well, I think it's potentially very significant as long as both countries actually make the cuts that they've promised. Saudi Arabia generally does exactly what it said it will do, so we expect this output cut that they've now extended from July through August at the very least, and they may yet extend it further. We expect that to be made. For Russia, their history so far is much less clear. They announced output cuts back in February to come into effect from March. We've seen no sign of those in any of the export figures, and that's what really matters, the amount of oil leaving Russia to the world market. So we wait and see whether Russia actually implements this cut. And if it does, then I think it's significant.
OK, so that's where we see whether this is significant or not. And what about the ability of this cut to put a floor under prices? Because we saw a short spike up in prices and then back down to $75 again on Brent.
Yeah, I mean, I think that we are moving into a period of the year where almost everybody is expecting the market to tighten. If you look at the major forecasting agencies, I mean, OPEC itself, the International Energy Agency, they are seeing a very significant supply shortfall in the second half of the year. Most of the banks see the same, although they have trimmed back a lot of their price expectations. But if we do get an additional 1.5 million barrels a day taken off supply in both July and August, and then possibly extending that further through the year, I think that will be enough to put a floor under prices. But as I say, it really depends on those cuts actually being made.
Julian, thank you very much. All eyes then on Russia and whether they do what they will say they will do in terms of production levels. Oil strategist here at Bloomberg, Julian Lee, thank you for joining us. Coming up on the programme, I'll be speaking to the Allianz Chief Economist. Ludovic Subran joins us shortly. We'll talk about the outlook for the global economy. We'll get his take on the resilience of the financial sector as well. When we last spoke in the month of May, he talked about financial accidents and he was worried about those and their ability to drive down liquidity. Is he still concerned about that? Still concerned about the commercial real estate sector and its linkages into the banks over in the United States? Or can we put some of those concerns behind us? We will talk about that conversation coming to us from the Europlus conference taking place in Paris. This is Bloomberg. Welcome to the Pulse. I'm Anna Edwards in for Francine Lacqua this morning. Let's get to our headlines. The RBA holds rates but warns further tightening may be needed amid continued inflation pressures. The Aussie dollar rebounds from earlier declines. Hitting back, China ups the ante in a trade war with the US and with Europe, imposing restrictions on two metals critical for chip manufacturing. Plus, crude rises after Saudi Arabia and Russia announce an extension to oil supply cuts. Welcome back to the programme. As I said, I'm Anna Edwards in for Francine Lacqua on the Pulse this morning on Bloomberg TV. Let's get to some important research and another perspective on the global economy. Allianz Research expects the global economy to stage a timid recovery from mid-2024 after a soft landing. The Allianz Chief Economist Ludovic Subran joins us now from the annual Paris Finance Forum that is Europlus. Thank you so much for joining us, Ludovic. Very nice to have you with us. So that suggests a fairly decent soft landing for the global economy. Is that what you're expecting to see?
Yes, well, it depends vividly on central banks' determination to kill inflation, I mean, what is fascinating today is one of the main risks to the economy is the risk of policy mistakes from central banks and this toxic policy mix risk between fiscal and monetary tightening at the same time. So behind our soft landing, even though I don't find any landing to be soft in history, there is this assumption that, policymakers do the right thing at the right time. So maybe don't, pull the plug too strongly, too fast on the support mechanisms, especially in the US and Europe, of course.
Well, but I'm interested in what defines a policy mistake from a central bank, Ludovic. If we end up in recession, but it can be justified by the fight against inflation, does that equal a policy mistake, do you think?
Look, last week I was in Sintra for the ECB forum, and the President Lagarde actually mentioned that she's going to be looking at some of the pass-through, some of the transmission uncertainties and so forth. But for me, what would be a policy mistake would be the decision to wait for the full pass-through, meaning this data dependence, obsession that central banks have, could yield to a moment where we decide to pivot when it's already too late, which means the embedded tightening from central bank to the real economy is already visible. And for me, this is already too late. So that's a policy mistake. And this is a little bit the discussion that happened last week in Sintra, which is what would happen if the ECB were to hold rates high on top of adding a couple more hikes for the full of 24 to see the full transmission. This, for me, would qualify for a policy mistake because that would mean we would start seeing the real economy effect of this embedded tightening. And so that would be already too late for the central bank to pivot.
Ahead of 2024, though, I assume, Ludovic, when do we get to a position where the ECB can hold and does not need to be hiking anymore? Of course, we've seen this pause, or maybe it's a skip at the Fed already.
It's interesting. I think what came up a lot last week was this wage price spiral risk, which seems to be quite the question that everybody has in mind in Europe, because we've seen some inflation in the services sector. And we also know that some countries in Europe have some form of indexation or maybe a public sector wage bill that is very strong, and that leads to some form of additional, upside risks, I would say, on the wage bill. You also see what's happening a bit on the social risk in a lot of countries. So I think the risk now is to say, okay, maybe they will hike till they see that wage inflation and especially services inflation is under control. That could be, let's say, in the fall. So I would say a couple more hikes, and then they hold still as of Q3 or maybe beginning of Q4 this year.
Ludovic, last time I spoke to you was back in the month of May, and we were talking in the aftermath of all the turmoil in the banking sector over in the United States in particular, and then in Switzerland, obviously, notably. You at the time were concerned about financial accidents driving down liquidity in markets. Do you still have those concerns?
Of course. They haven't disappeared, This is the good news is, I would say, that at least in Europe we have avoided, I would say, the contagion risk of the banking crisis. This is good news. That means that the banking crisis we had 10 years ago was a good fire drill, and that we've built the right tools to avoid, I would say, such a liquidity crisis. But I still see a lot of leverage and a lot of concern about credit risk. And to be fair, a lot of financial institutions also that need to continue to do the right stress testing. And remember, the financial accidents could also come from exogenous shocks. Think about climate risks that is really piling up, and that is creating a new form of exogenous risk for some of the financial institutions. So I stand by my call to be very cautious with the liquidity situation altogether for at least the next 12 months.
OK, so be cautious around liquidity on that 12-month horizon. Can I ask for your more broad outlook around inflation, Ludovic? Are we in a regime where we don't see interest rates going back to post-GFC levels? Do you expect that we will never return to the low interest rate environment that we saw in decades past?
No. I think inflation. I don't want to say inflation is transitory, because that would be quite a bummer. But to be fair, we start to see really the effect of hiking on inflation. We also see the softening of consumption in some countries. So I would say we're going to be certainly, the experiment of zero interest rate is certainly behind us for quite some time. But I don't think we can stand, 5% in the US or 4% in Europe for more than, I would say, a year or so. So I expect that there will be some cuts on interest rates. I also expect inflation to be back under control. Like a lot of people, I'm worried about the residual inflation from fragmentation and decarbonation and demography. But we're talking maybe of about half a point of percentage. So maybe something hovering around 2.5% instead of 2%, which is something that maybe central banks will have to answer in the coming years, which is whether the 2% target makes sense when you look at the labor market. But I don't think we're going to be at 5% inflation and 5% rate for the following 5 years. This is going to get normal again. Don't worry about this.
OK, I won't worry then, Ludovic. We'll look forward to what we would have called normal some time ago. But you did mention some of those structural factors that do put upward pressure on inflation. You mentioned fragmentation, the decarbonisation, demography, all of those well quoted. I was drawn to a comment by Megan Green, who's soon going to be joining the Bank of England, yesterday. And she was actually talking about the way that AI could be inflationary. Do you have thoughts around AI and the impact? Because more traditionally, we might have thought that technology would put a downward pressure on inflation.
Actually, last March, we wrote a report which was called the 5 Ds of inflation, and there was demography and decarbonation and deglobalization, but there was also digital and debt. So we were also worried about the fiscal profligacy, creating a bit of additional order books that were creating a bit of inflationary pressures. But we were worried about the tech sector being slightly inflationary now after decades of being deflationary. The reason is behind this are the cartels, the oligopolies, the fact that it's a very little competitive market. You have this, winner takes all, and so that's not good for price setting mechanism. And the second reason is because a lot of the ecosystem, I would say, around tech is inflationary by nature because it requires a lot of investment. And so you need a bit of overheating to make sure that there is this capex, this investment going into this sector. So those were the two reasons why I would agree also with Megan Green on this idea of tech being slightly inflationary going forward.
Ludovic, thank you so much. Very interesting conversation. Thank you so much for joining us. The Allianz Chief Economist, Ludovic Subran, joining us from the Europlast conference taking place in Paris. Coming up on the programme, ESG funds that bought into Thames Water's green bonds are in perhaps hot water. And is it clean enough for them? This, as the UK's largest water supplier teeters on the brink of bankruptcy. We will dive into that story next. This is Bloomberg. Welcome back to The Pulse, the conversations that matter and the insights you need. I'm Anna Edwards in London, in for Francine Lacqua this morning. Now, ESG funds that piled into green bonds sold by Thames Water are facing a dilemma. That's after a string of environmental, social and governance disasters hit the UK's biggest water company. Former UK Business Secretary Vince Cable spoke to Bloomberg earlier on the troubles the company and the government are now facing.
Thames Water isn't the only water company in trouble, but a capital raise from the government's point of view is by far the best option, though there will be painful conditions. I mean, I would imagine that the investors are expecting to see prices rise to ensure that there's an adequate return in future. But if the capital raise falls through, then the government is forced back into public ownership, because you can't just allow a water company to collapse.
So Vince Cable there, and to his point, Ofwat itself has actually expressed concern about the financial resilience of Thames Water, Yorkshire Water, SES Water and Portsmouth Water. Let's talk about another angle on this story. Tasneem Brogger joins us, oversees Bloomberg's sustainable finance coverage for the EMEA region. Tasneem, very good to have you with us. So Thames Water has a lot of bondholders, but this is also, there's a big green investor base here, green bondholders specifically. How are they approaching this crisis?
That's exactly right. I mean, obviously, all bondholders in Thames Water at the moment are looking at this situation very closely and wondering how it's going to unfold. But there is, as you say, specifically a group of bondholders that sought out Thames Water debt investments because they thought they were extra green and extra protected from environmental disaster. We worked with Morningstar and identified more than 200 ESG funds that hold about $240 million worth of green bonds that were issued since 2022. And obviously, since that time, the headlines have been full of stories of sort of sewage leaks and the extent to which Thames Water has been, they themselves acknowledged, behind environmental damage. We've had some investors, we spoke to Schroders, that last year they said it was too much, even though the green bond is ring-fenced, it's only supposed to be use of proceeds that you look at. But they said the fact that the issuer is so engulfed in problems, they were getting out. We've had other investors like Nordea say they wouldn't even touch them in the first place.
OK, all right, so that's really interesting, the different views that exist on the green bond. I mean, what does this tell us about the ESG debt market if you can get into quite so much trouble with regulators over pollution and then still be considered green? Has the ESG sector or environmental bonds, green bonds, have they focused too much on carbon and not on other things?
Yeah. So, I mean, the green bond is sort of unique in that it has a use of proceeds clause. So specifically, as an investor, you think, OK, well, I'm only looking at how the company is using the proceeds that I've given them for this particular bond.
And it's for a greening purpose, is that the idea?
Precisely.
Right.
But in the case of Thames Water, one can see that obviously some investors are starting to look at the issuer themselves and the wider problem that the issuer potentially finds themselves in. We've had UK SIF, which represents sustainable investors in the UK, the CEO come out and say, you know, you can't be blindly ignoring the circumstances around the issuer, even though the bond is supposedly ring-fenced. We've had the new CEO of Thames Water, Adrian Montague, come out and say, look, he's going to work with investors and with regulators and try and sort of sort out the issue. But clearly, it's something where green bond investors are sort of starting to wonder, is it enough just to look at the use of proceeds?
Can it be called a green bond if you're just very much at the beginning of the greening process, even though that's where a lot of the money will be needed? Tasneem, thank you very much for bringing us the story. Bloomberg's Tasneem Brogger with that really interesting take on Thames Water and the ESG dimension. In more ESG news this morning, Spain is ramping up over 18 billion euros in green hydrogen investments. It's Europe's most ambitious effort yet to implement technologies critical to becoming the world's first climate-neutral continent. But will the demand be there? Bloomberg's Chris Reiter joins us now with some thoughts on this. And Chris, where and how is this money going to be spent then by Spain?
Yeah, well, it's a broad-based investment program. It runs like all across the country, from the north to the south to Valencia. The biggest hydrogen generator is in Puerto Llano, which is just south of Madrid. And the kinds of investments run from generation to transport.
Right, so it covers a whole host of things. And where's the cash coming from?
Well, it's coming from, there's private investors, there's companies like Cepsa, which is a refiner, there's Iberdrola, which is Europe's largest green energy developer, and then there's government money, a lot of government money. There's government money from the Spanish government and from EU funds as well that are helping fund a pipeline that's going to bring that hydrogen, allow Spain to export some of that hydrogen to France and beyond and on to Germany.
Other countries not pushing quite so quickly on the green hydrogen front. Why is Spain taking the lead here compared to some of the other European nations?
Yeah, well, it has an advantage in terms of its solar power, and it has that massive amount of space. It has the best conditions in Europe for solar power. So that's a key component of green hydrogen, is cheap, clean energy, and that's what Spain has, and that's why it's pushing it, and that's why it's trying to get into the space before anybody else, to be honest.
Chris, thanks so much. Thanks for bringing us the story, really important story on the Bloomberg terminal this morning around Spain and its hydrogen push. Bloomberg's Chris Reiter joining us there with details. Later today, we'll be speaking exclusively with Spain's Foreign Minister, Jose Manuel Albaraz. That conversation later today as the nation takes up the presidency of the European Union, 4:30 p.m. London time. Stay with us for that. Coming up in the next half hour of programming, it's Musk versus Zuckerberg, apparently. Instagram's answer to Twitter looks set to launch later this week. Will the new Threads platform be a threat to the incumbent? We'll discuss that next. This is Bloomberg. Welcome back to The Pulse. I'm Anna Edwards in London, in for Francine Lacqua this morning. Let's get a check on the markets, shall we? And this is the picture we have for you right now. Across European stocks, up by 0.2%. Of course, no trading in the United States, no cash trading of equities. We've got the futures picture in there, but we know there's no cash trading today. It is the 4th of July, so happy Independence Day if you are celebrating wherever you are. So S&P futures do show a little bit of downside, but no great movement. In terms of the sector breakdown, we've got real estate and healthcare doing pretty well today. Construction and materials, energy, basic resources, those are the laggard sectors. The Brent price, as you see there, up by 0.8%. Yesterday, we heard from Russia joining Saudi Arabia in its push to try and put a floor under prices. How effective will that be is a big question. We talked to our colleague earlier who was suggesting it all depends whether Russia sticks to the commitments it has made. For the moment, we've seen a little bit of upside on the oil price. 75.27 is where we trade after we popped higher to 76 in yesterday's session, but have come down. The Australian dollar actually dropped this morning after we heard from the RBA. They didn't, as half of the economists had expected, they didn't hike rates. They paused on rates. And that's an interesting talking point, really, in terms of the global central banking narrative. Does that tell us anything useful about the value of a pause? We certainly heard that view from Ewan Munro over at Newton earlier on. But the Aussie dollar then recovering a little bit from that earlier sell-off. Let's get to some top stories this morning that we're covering here at Bloomberg. Lazard is said to have fired a senior dealmaker after allegations of inappropriate behaviour during a weekend party. Bloomberg sources say the managing director was sacked for actions that were deemed incompatible with the values of the company. Incoming CEO Peter Orszag informed staff about the move on Sunday via an internal memo. The document did not name the individual or disclose details of the incident. Harvard University has been accused by minority groups of violating federal law by giving preferential treatment to children of alumni and wealthy donors. The complaint comes days after the U.S. Supreme Court struck down the use of race-based affirmative action policies. The minority groups say the long-standing practice of legacy admissions favours white students and breaches the 1964 Civil Rights Act. Alibaba is said to be exploring options for its video entertainment assets. Youku and Tudu, as the Chinese tech giant wades deeper into its plan to revamp its structure. Sources tell Bloomberg one of the options under consideration is to inject the assets into Alibaba Pictures Group and bolster the business scope of the Hong Kong listed company. Meta's Facebook has lost its fight at the EU's top court to topple a German antitrust decision that imposed an overhaul of the US tech firm's business model. The court says that the Federal Cartel Office didn't overstep its powers when it slapped the social media firm with its landmark 2019 order. The case is viewed as a test of how far European antitrust regulators can go to make sure Silicon Valley firms don't mishandle massive data sets gleaned from users to cement their market power. Now, two more big tech stories for you today, and we'll discuss these. Instagram's answer to Twitter Threads is to Twitter, and it's called Threads, is expected to launch on Thursday, while Yahoo wants to make a comeback by taking the company public once again. That's according to the Financial Times. Alex Webb has been digesting both of these stories for us. Bloomberg Quick Take correspondent and joins us now. Alex, good morning. So let's start with Twitter rivalry. So Threads coming from Instagram and Meta. What should we expect to see? I think Thursday is the date we expect to see the launch.
Yes, that's certainly what the App Store seems to indicate. You can sort of pre-order it, as it were. It's a free app. You can say you intend to download it, and then when it becomes available, it will download onto your phone. It says expected, essentially, on Thursday. It is really their effort to capitalize on all the issues, partly, prompted by the Elon Musk takeover at Twitter. It's been losing advertisers. There have been changes to the platform which have made people concerned about trust and whether the content getting there is safe, particularly for advertisers. So Facebook is looking, or Meta is looking to capitalize on that by introducing this app Threads. It will be linked to your Instagram account. The interesting piece really is they have got track record of essentially mimicking. I think they've even said openly they copy other people's.
And some of those have been successful.
Exactly. So we've seen Instagram has had pretty good success with Stories, which is a pretty shameless rip-off of some of the functionality of Snapchat. In fact, the Snapchat CEO's wife said that his job should be described as the CTO of Instagram. They also have some that are failures. Do you remember Facebook Paper, for instance?
No.
Facebook Paper was their effort essentially to do Flipboard, to bring a magazine or a mobile native magazine app to smartphones. It went nowhere, it died a death. So the question is really, is it going to be Paper or is it going to be Instagram Stories? OK,
really interesting. So they've got some success, but also some examples of where they've not been successful. Let me ask you about this blast from the past, it almost seems like. Yahoo wanting to go public again. What's prompting this?
Well, it's owned by a private equity company. So, it was a private equity took it off the hands, Apollo took it off the hands of Verizon, who owned it for about 5, 6, 7 years. They paid $5 billion for it, as ever with a private equity company. They're going to be seeking an exit at some stage. So even if we may not be using it on a daily basis anymore, it remains a top 5 website globally by some measures, by traffic, really. That means there is clearly potential to monetize that. The really interesting thing will be having a glance at the financials as it gets on an IPO roadshow to see exactly what has happened while it's been in private hands. I can't wait to have a look under the hood.
Yeah, absolutely, to see what debt levels look like or the like. I wonder if they'll mention AI, Alex.
I think there's a pretty safe bet that
if you're doing something in tech and it's 2023, then I think
Yahoo-based AI drinking game will get everybody in trouble.
OK, we'll look for that in the prospectus. Thank you very much for that. Bloomberg Quick Take correspondent Alex Webb with the latest on a couple of tech themes this morning. Just time to tell you about this last story. The world's wealthiest have added more than $850 billion to their fortunes in the first half of 2023, with Elon Musk and Mark Zuckerberg leading the surge. That is according to the Bloomberg Billionaires Index, which showed the 500 members of that index made an average of $14 million per day in the past 6 months, just demonstrating, I suppose, the strength in stocks that we saw in the first half of the year and what that did to the fortunes of these world's richest. Up next, Bloomberg Markets with Yusuf Gamal Eldin. It is Independence Day, no US trading. European stocks go modestly higher. This is Bloomberg.